Good afternoon, everybody. Uneducated economist here. I was just reading this really good article talking about the University of Bath research paper talking about how negative interest rates have been damaging the banking system. And it's kind of complicated to try and understand or break it down what the whole banking system between loans and overnight lending rates and excess reserves. Essentially what has happened is that the commercial banks, not the central banks, but the commercial banks like the JP Morgans, Goldman Sachs, those kind of banks, at the end of the day, they would have reserves. And the ones who had excess reserves would loan those out to the guys who were in need of reserves until everybody was kind of equal. And that was called the overnight lending rate. Okay. And now the Federal Reserve would try and establish that overnight lending rate. That would be the effective fund rate, whatever that rate ended up being. And they would try and manipulate that rate by buying and selling treasuries off those banks' deposit sheets until they could kind of get the interest rates to land where they wanted to. But they've been working in an abundant reserve system where everybody has excess reserves. And so they've been depositing those excess reserves with the Federal Reserve Bank. And they're using something called an overnight reverse repo rate or whatever, but it doesn't matter. What they are doing is they are depositing it with the central banks. And these banks across the world have been essentially doing the same thing. But these central banks have been trying to push out loans. And so in order to keep the banks from depositing those excess reserves with the central bank has dropped the interest rates to zero and then into negative. And they're saying, hey, don't deposit this money with us. Get it out there and start loaning it. Well, the problem with this is that on the opposite end, the interest rates have gotten down so low that the banks are no longer profitable. And if they are being charged to have these excess reserves, then what they are telling depositors now is that don't deposit the money with us. We're getting charged excess reserves. So take your deposits and get them out of here. Now, the problem with that is that deposits is what makes banks profitable. Because banks don't actually loan out money. They don't loan out your money. They loan out money, but they don't loan out your money, the depositor's money. What they do is they take a signed loan. I'm going to try and break this down really simply. But they take the signed loan and they use that to get the money. And they put that on their balance sheet as an asset and a liability. The asset is the loan that they have had you sign, and the liabilities is all the money that they have given out. And as the liabilities come in, the asset gets paid back and its bank is back at zero. So the bank essentially has a zero book balance sheet. But as people put deposit money with the bank, it offsets those liabilities. And if you have more liabilities in your bank, then it makes if they're bringing in the liabilities that you have, then it makes your asset more profitable. Does that make sense? So if you have liabilities and assets that are equal, but then you get more of those liabilities in by depositors putting money in with you, and then you can take that money and in turn deposit it at the central bank who will give you an interest rate. Now the central bank is saying, hey, we don't want your money here. And now the depositors are being told, hey, we don't want your money here by the central banks. And this is causing damage to the banks because now they're no longer profitable. This is what Dr. Ru Zai had to say. This is a good example of unintended consequences. Our study shows negative interest rate policy has backfired, particularly on an environment where banks are already struggling with profitability, slow economic recovery, historically high levels of non-performing loans, and a past banking crisis deleveraging phase. If bank margins are compressed due to low long-term yields and there is limited loan growth, then the bank profits will fall accordingly. The decline in profits can erode bank capital bases and hitherto further limit credit growth, thus stifling any positive impact on the domestic demand from negative interest rate policy monetary transmissions effects. So they're basically saying that the whole idea of dropping rates into negative territory has the unintended consequences of causing the bank profits to erode. And if the bank isn't profiting, then they're not going to be able to loan. And if they're not loaning out the money, then they're not stimulating the economy like the negative rates are supposed to do. All right. Very confusing. Hope you guys got it. Uneducated economist, you guys let me know.